We are now going to look at section 11F, the retirement deductions section. Now, just as a quick reminder, well, I'm not actually going to say natural persons, we know this relates to natural persons. Taxpayers who earn mainly a salary will still be allowed to, or will be allowed to deduct this per section 23M. This is just a reminder actually for you to go and look at section 23M again and see that section 11F is one of those allowed. Now, this section is a section that has changed a lot over the last couple of years. Almost every year for the last 4 or 5 years, there's been changes in the Act to this section. Sometimes there's some words, other times adding or removing certain clauses and paragraphs and subparagraphs. So it's taken a while. For long before this, we had two sections, section 11K, section 11N, which is your pension funds, retirement, annuity fund deduction sections. So if you remember any of two separate sections like that, guys, that is in the distant past now for us. We are now looking at section 11F. Now, what is section 11F? Section 11F allows you to claim a tax deduction for contributions that are made to retirement funds. Now, retirement funds are things like pension funds, provident funds, and retirement annuity funds called RAFs. Now, we don't go into too much detail on tax, on the differences between pensions and provident funds and retirement annuity funds. I will talk about differences when it is necessary. But understand, in the past, we were only allowed to claim deductions of pension funds and allowance deductions for retirement annuity funds. We were not allowed to claim deductions for provident funds, okay, if we make contributions to it. So what is this as an example of? So you are employed somewhere, and you earn a salary of 10,000 rands a month, and in terms of your employment, it tells you that you need to contribute 8% of your salary to the company's provident fund. Right. That amount you are allowed to claim as a tax deduction based on the rules contained in section 11F. Okay, now just quickly, what is a pension fund? Pension fund, in simple terms, the idea behind it is you contribute an amount of your salary to it, and one day when you retire, the pension fund will pay you a percentage of your final salary. So it'll say 90% of your final salary or 80% of your final salary. Now, the nice thing about a pension fund for you and me, if we belong to it, is that you are guaranteed what your pension is going to be one day. So remember what happens with a pension fund is people have to take, fund managers need to take money and invest it in shares and basically in shares and properties, investment unit trusts and those things like unit trusts and those things, property unit trusts. They have to invest it in there and then it earns income and they then use that money to pay out pensions. Now, if the fund does well, then it's not a problem. If the fund doesn't do well, then there is a problem, and someone has to get that shortfall, pay that shortfall, and usually the company to which it belonged. That is why. So, what is the benefit for you and me? You guaranteed what you get. What's the negative thing for the company is that they will have to, and the fund, they will have to pay out even if they don't really have money. A provident fund, on the other hand, is different. A provident fund, they say, we'll invest your money. We'll take your money, we'll invest it. And then if we do well, one day, when we pay out to you your funds, you will get a lot of money back. You'll get a high provident fund payout. But if we don't do well, you'll just get less. So you carry the risk and the rewards as the taxpayer. Now, that is why mostly you'll see we are moving away from pension funds to provident funds, because it's taking away the risk from the fund, giving it to you and me, which is not so nice. Now, a provident fund and a pension fund are both linked to employers. So what does that mean? It means if you work for Coca-Cola, you'll belong to the Coca-Cola Provident Fund. If you work for the government, you'll belong to the government pension fund. and then your investments are in your pension. It's just random investments sometimes, it seems. Right, but obviously that's just a little joke. But you belong to a company's pension and provident fund. A retirement annuity fund basically works the same as a provident fund, and you'll invest money, and then one day you'll get annuities and lump sums paid out. But you do that externally. So in your personal capacity, you go to Old Mutual or Sanlam, one of these places, and you enter into an agreement. Okay, it's not linked to an employer. But all of these contributions that you make, you're allowed to claim a deduction for it. Now, what I wanted to see is, where does Section 11F sit in the tax framework? That Section 11F sits over here in our tax framework. Now, what's important to see is that it is after the taxable capital gain, but before the donations deduction. Now, I want to also just draw your attention to these two subtotals. Okay, the subtotal that you calculate immediately before your taxable capital gain, and the one that you calculate after your capital gain. We're going to refer back to them in a second. So, here is Section 11F. Let's read it. It says, notwithstanding Section 23G, for the purposes of determining the taxable income of a natural person, look, there's a reference to a natural person, in respect of any year of assessment, there must be allowed as a deduction from the income of that person any amount contributed during a year of assessment to any pension fund, provident fund, or retirement annuity fund, in terms of the rules of that fund by a person that is a member of that fund. Now, the rules of that fund, each pension fund, provident fund, retirement annuity fund will say you need to contribute 8% of your salary or 2,000 rands a month. They're just basically saying you need to do whatever is required of you. So don't do more or less than that. Then they say, so you are allowed, so up to there it says, just see how the Act works. The Act, up to there it says you are allowed to claim your contributions. But now it says, the total deduction must not exceed the lesser of. So this is the limit. So you may deduct the actual amounts contributed, but it is limited to the lesser of. So A, B, or C. Okay, so the lesser of A, B, or C. What is A? 350,000 rands a year. So you can contribute up to 350,000. Nice. Or B, 27.5% of the higher of that person's remuneration or taxable income as determined before allowing any deduction under this section and Section 6.1c and 18a. Section 6.1c is not in your syllabus, so you can ignore the reference to it. So they say the taxable income before 18a. Now, what does that mean for us? This is 18a. So they say the taxable income before allowing obviously this deduction and 18a. So they are referring to this subtotal over here. So let's call this subtotal for now subtotal A. Right? So they are referring there to subtotal A. So 27.5% times the higher of remuneration, and remuneration just for now, they say to you, it's paragraph 1 of the 4th schedule, just for quickly for this discussion, we'll go into it in a second. Remuneration is what you earn from your employer. Salary, wages, commission, bonuses, overtime, fringe benefits. Okay, those type of things. Okay, so remuneration and taxable income after CGT. After CGT, can you see? All right? Or C, remember there's 3 options, the lesser of A, B, or C. Option B is just this big, for option B you have to then do the greater of the 2 amounts. So it's just a bit more complicated, but C is the 3rd option. C is the taxable income of that person before allowing any deduction under this section, right, which is the same as the previous one, say, and 18A, and the inclusion of any taxable capital gain. So what are they talking about there? They're talking about subtotal B here. Right. So I suppose let's maybe do it a little bit differently. Okay. Let's change it up. Make it a little bit more logic. A and B. So they're referring to, the first one refers to B, and the second and C refers to A. So just up to there. For now, that is what the rule says summarized. It is the lesser of 350,000, 27.5% times the greater of remuneration, taxable income, or the taxable income excluding CGT. Now, just to give you a bit of an example, we have gross income, exempt income, and let's just say deductions, right? Okay, you do everything. Leave yourself some space open. So this is now how you'll do it in the exam. So exam technique. So you leave yourself some space open, calculate a subtotal there. I'm just going to thumb suck a subtotal here. Let's see how this works out. 500,000. Right? Then you have your taxable capital gain. Let's say it's 100,000. Gives us 600,000. Now you have section 11F. Okay, guys, so A and B, let's just call it out. So section 11F, this is how you'll write it in your exam. Actual will be your actual contributions made. So 8% of your salary, or 2,000 rands a month, whatever the case might be. Let's in my instance here, say that it is 40,000 rands for the year. This is how we write it now. And we say this is limited to the lesser of 350,000 or 27.5% times the greater of remuneration. That you'll have to calculate, but for now, let's assume that that is 450,000, or the taxable income after CGT, and I'm referring here to A. Oh, sorry, not A, B. Okay, so referring to that subtotal over there, which is 600,000. Right, so 27.5% times the greater of 450 or 600,000, which is the greater of 600,000. So thus 27.5% times 600,000 is 165,000, right? Or our third option is the taxable income before CGT, and this is A, which is the 500,000. Okay, so see now, our limit is the lesser of 350 or 165 or 500. So it is the lesser of, the lesser is 165. So that is the maximum that you're allowed to deduct, 165. So you're right. Thus, limited to 165. So I'm showing you exactly in the exam what your layout should be. You get marks for all of these conclusions that you make here. There's no shortcuts here, guys. You have to write out this big story. This will count a number of marks. So you say now, you're now making a conclusion. What is the limit here? It's 165,000. But then you say it is limited to actual, because you can never deduct more than what you actually contributed. So that 40,000 over there, right, that will be the deduction, and this will go into your rands column. Okay, so just up to there. A couple of principles that we can quickly just discuss here. Let's say my actual was not 40,000, right, this actual over here. Let's say this actual was 200,000. That's how much you contributed. Then the limit is 165,000. So it would be 165,000. If that is the case, I want you to see you contributed 200,000 is 165,000 rands. That difference over there that difference over there is important. That difference over there will be carried forward to the next year. But there's a couple of things that can happen to it first. This is called the excess. Okay, so when you hear me talking about excess or contributions disallowed, because what is your contribution? It's the 200,000. What is allowed? 165,000. So 35 was contributions disallowed. So if you hear me talking about excesses or contributions disallowed, I'm talking about this. Okay, and if you see that in the Act. So if I take you now to subparagraph 3, it says, any amount contributed to a pension fund, provident fund or retirement annuity fund in any previous year of assessment which has been disallowed, okay, can you see a disallowed contribution, solely by reason of the fact that the amount that was contributed exceeds the deduction allowable in respect of that year of assessment. This is okay up to there. The contribution is 200,000 Rand, it exceeds the amount allowable. So they're talking about this exact situation we're talking about here, that 35,000. So that is, they say, if that happened last year, what do we do with that 35,000 Rands that we had last year? So last year's excess. They say that excess is deemed to be an amount contributed in the current year of assessment. So you carry it forward to the next year. Then they say, important here, except to the extent that that amount has been allowed as a deduction against income in any year of assessment, accounted for under paragraph 51A or 61B of the second schedule. And I want you to just write there, this is deducted against lump sums or exempted under section 10C. And this is the against an annuity received. Okay, now some of these you will study separately under retirement benefits. I'm not going to go into the detail there now. Just understand that if you have this excess over here, and this is probably the most complicated part of this, but it is very simple. You'll see in a second, and I'll explain more. But this excess here, this 35,000 rands, there's three places it can go to. It can go to lump sums, it can go to annuities, which you'll receive under section 10C, or it can go to section 11F. And this order that I've given you here is how you will apply it. So you'll apply it against lump sums if there were any. If there's not any, or if it's still left, then you'll apply it against annuities in terms of section 10C. If there's still anything left, or if none of these are applicable in the year, then it goes to section 11F. Now, don't get too panicked here. Okay, don't get too panicked here. You will study this in more detail once you understand retirements. For now, what I want you to understand is, we haven't looked at lump sums or annuities yet. So, and this is obviously possible also. So nothing of this has happened in this year, nothing of this has happened in this year. So then you can only have section 11F. Okay, so what would happen is, if you had 35,000 rands in the prior year, and this year you had 200,000 rands actually, you will just say it's now 200,000 plus 35,000. So you make your contribution 235,000 rands. Okay guys, so let me just recap and make everything together now so that you all just focus on what I want you to focus on now. The focus up to now is just section 11F. How does deduction work? It's the actual limited to the lesser of 350,000 or 27.5% times the greater of remuneration or taxable income after CGT, or the third limit, taxable income before CGT. It can never be more than the actual amount, but the actual can never exceed the limit. Okay, this is the maximum you can ever do if it's not limited. The excess, all I want you to understand for now is that there are things that can happen with it. So I don't want you to just go and say, this is always the rule. But I want you to understand for now, one of the options, the three options that can happen, is that it will be carried forward to section 11F in the next year. For now, I want you to focus and say that is the only thing that you're studying at this point in time, carrying forward to next year. And that's very simple. You just add it to whatever the contributions were. Okay, then 4, which is important here, any amount contributed by an employer for the benefit of the person must be deemed to be equal to the amount of the cash equivalent of the taxable benefit in terms of the 7th schedule. So this is the fringe benefit. Right, so fringe benefits are amounts that you receive from your employer or other benefits. You get taxed on it. So they say, if your employer makes a contribution to the pension fund, whatever the fringe benefit amount is, then you'll be treated as if you contributed that. Now, let's just quickly talk about it. Some of you might have heard, and some of you might currently have it, where your employer says to you, okay, you earn a salary of 10,000 rands a month. You will contribute 7% to the pension or the provident fund, and we will also then contribute 7% to the pension or the provident fund for you. That amount that the employer contributes, you'll be taxed on as a fringe benefit, but you will then be treated as if you contributed it. So, what does that mean? It means you can still claim a deduction for it even if you didn't pay it. So, if you made contributions yourself of 200,000 rands for the year, so you contributed 200,000 rands, and there was also a fringe benefit, your employer contributed 100,000 rands, your total will be 300,000 rands, your actual. Okay, just want you to understand that. So you still get the benefit. And then over here, just something to be aware of for now, if there's a partnership, if you're in a partnership, so as natural persons get together in a partnership, you are still a natural person, you're still treated as a sole proprietor. Partnership is not a separate tax person. It's a separate VAT venture, so not a separate individual for tax, income tax. So, you cannot, if I'm a partner in a partnership, I can't be employed by the partnership because I'm then employing myself, because I'm working for myself. This section just says, just for this purpose of this section, we'll treat, if you are a partner in a partnership, we'll treat you as if you are an employee of a partnership and as if the partner is an employer. The partnership is an employer. The reason for that is just to make it that if your partnership is paying something on your behalf, so the partners get together and they pay, you can still get the benefit of that. So guys, the one thing we just haven't spoken about is what is remuneration. Remuneration is defined in paragraph 1 of the 4th schedule, and I want you to understand it's the following: salary, leave pay, wages, overtime, bonus, commission. All of the amounts that you receive from your employer. Important here, any annuities that you receive. Now what is an annuity, guys? So you retire one day and your pension fund pays you an annuity every month. You need to remember, first of all, that annuities, paragraph A of the gross income definition tells you that it's a special inclusion to gross income. But an annuity is then any amount which meets the following requirements. It's an annual payment. That payment can happen monthly, weekly, 6 monthly, once a year. It's an annual payment. It's a fixed amount. Fixed amount means fixed or determined amount, you could also say. It means you know what the amount is. It doesn't just vary. So, for example, a commission varies. It says if your commission is 10% of what you sell, it depends on how much you sell. That can't be an annuity. An annuity is something where you know every month we're going to receive 5,000 rands. That 5,000 rands will increase each year by inflation. So you know exactly what you're going to get. That's an annuity. And there's an obligation to pay. Now, the most important one I want you to understand just for now is if you receive pension, provident, or retirement annuity fund annuities, that will be remuneration. Any restraint of trade payment received, any fringe benefit, any subsistence allowance, but important here, or just for now be aware of it, there's no employees tax on subsistence allowances unless it was received by the end of the last day of the, if by the last day of the next month, the amount has not yet been used. Okay, for now, just be aware of this. I don't want you to worry about it. We'll look at it under an employees tax. Very important here, travel allowance. If you receive a travel allowance, you receive 5,000 rands a month. 80% of that is considered remuneration. Company car fringe benefit, you'll study that one in more detail on fringe benefits. 80% of that is considered remuneration. And anything under section 8B and 8C. Okay, now, most important for now, guys, salary, wages, overtime, travel allowance, and company car fringe benefit. I just want you to be aware of it. So if you receive 4,000 rands a month from your employer as a travel allowance, 80% of that will be considered remuneration. Okay, you'll see examples of that obviously as well. Now, I spoke about the past contributions disallowed. This is just a formal slide. Past contributions disallowed, guys. That's where you contribute 300,000 rands. The limit says 165,000, so it's only 165,000 rands. You contributed 300,000, you could only get 165,000 rands. So 135,000 rands of that is disallowed. What happens to that? I said to you it carries forward to the next year. There's just the formal notes that tells you you will first do it against the lump sum, then against annuities, and then as part of section 11F. Now, for now, I want you to just focus on this. Once you revise your work, again, once you've done retirement benefits or revised retirement benefits, you come back to this, that'll make much more sense. Okay, now, just a couple of notes here. I don't know necessarily how much detail this will go into, but let's be aware of it. You were previously allowed to deduct pension fund and retirement annuity fund deductions, but you were not allowed to deduct provident fund. Now, because this new section came into play 1st of March 2016, basically what they say is, any pension and provident retirement annuity fund contributions that you incurred before 2016, you are allowed to bring that into account for section 11F. But any provident fund contributions before that date, you cannot take into account for section 11F. You can only knock them off against the lump sum or the annuities. Okay, guys, that's just something to be aware of. It's a bit more of a technical issue, not necessarily something that I expect you to see too often, but please do be aware of it.